The effect of this increase in aggregate demand is to shift the aggregate demand curve to the right. This results in a new equilibrium in the economy, and we see that output increases. This means that the economy would achieve economic growth. This economic growth, this increase in output, would mean that more people would be needed to produce this output, and so unemployment should be reduced. The negative effect on the economy is that we can see that the price level rises. In other words, there'd be an increase in the level of inflation in the economy. So the question has to be asked, how effective is monetary policy likely to be in the economy? Well, the first thing to ask is, how much are consumption and investment influenced by interest rates? It's true that they are, but they can be offset by changes in consumer and business confidence. As I record this, the base rate in the UK is 0.5%. You can get a car on interest-free credit, but people just aren't buying cars because there's a lack of consumer confidence. So you shouldn't assume that when interest rates come down, consumption and investment will automatically rise. It depends upon the confidence of consumers and business people as well. The other thing is that interest rates in this country can't be too far out of line with our competitor countries or our trading nations. If that was the case, we'd see huge flows of money in and out, and it could be very destabilising for the economy. Thirdly, as interest rates come down, they tend to have less and less effect. Cutting interest rates from 6 to 4% may well have a significant effect on consumers and firms in their behaviour, but cutting it from 2 to 0.5% is unlikely to. Once interest rates go below a certain floor, it's normally thought that there's not a large rise in demand for loans. This is what Keynes called the liquidity trap. And lastly, the effect of the monetary policy to a large extent depends upon the position of the economy to begin with. Here, this diagram is meant to show two identical shifts of aggregate demand. Over here, the economy is far away from the full employment level of national income, and what happens when we get an increase in aggregate demand is we get a large increase in output and only a very small rise in inflation. Over here, however, where we're approaching the full employment level, where aggregate supply becomes totally inelastic, what you get is you get a much smaller increase in output for the same increase in aggregate demand, but you get a much larger rise in inflation. So the effect of any monetary policy is going to depend upon where the economy is to begin with.